Live from an active construction site in Bedford, New York, and here in Charleston, South Carolina, Stephen Whiting and David Balin on The Point, talking a little bit about Iran's war's inflationary impact and what we're calling the new negative feedback loop, which are the impacts to the global and U.S. economy. And we're going to be spending a lot of time talking about today. Obviously, there's been a whole lot of news about the war in Iran, and specifically about President Trump's decision to delay any more active military action due to some negotiations that are supposedly underway. We'll talk about that, but ultimately all of this is going to be focusing on the Strait of Hormuz and whether or not it reopens and what that impact is on the energy markets. We've seen Brent crude oil move about 40% higher since the world began. We're going to be talking today about really the comparisons of what that means to prior situations, including the pandemic of 2020. Now, if we think about what's going on in the world economy and we utilize futures prices, as Stephen will go through in detail today, it gives us a sense of the impact that it's going to have on how consumers and producers make or lose profits associated with these activities. And that is going to have an economic impact on GDP and obviously on the way that the stock market operates. Similarly, as we'll remind you during this call, we've seen a 40 basis point move in the US government and private debt markets. Now, what we've also seen is the inability of anything to really hedge this market. It has been a risk-off trade across all global markets. That is something that is ultimately going to resolve in different ways, but it's been an unusual reaction where people are seeking liquidity. And lastly, we're going to talk very, very briefly about how short duration bonds have actually done well as specifically what kind of them, and as we go through this. Now, today's conversation is going to be a little more technical than our normal ones, so I'm going to ask Stephen a bunch of questions to make sure that even I understand what he says. So Stephen, let's just talk about the backdrop for this for a second, which is before the war, right? Even with prices going up as people anticipated a possible conflict, we had no supply issues. And so you're curious, even though the straits are closed, do we still have a supply issue?
Well, we do have a supply issue in the sense that it's in the wrong place. It's being held underground. Wells in Iraq are being shut in because there's no place to move it. And we also have just the inability to get shipping out of the Persian Gulf. And I think this picture on the right just shows how binary it is. If we take a look at daily port calls data for the UAE, if you think about Dubai and Abu Dhabi, if you think about these cities, they're not getting any trade at all. Any goods are not coming in and out of the ports. So that's just a complete shutdown of what picture that you see at the left for a portion of the world's oil. And
now,
we've said many times, oil moves up so much more rapidly than supply losses.
Right. This is different than 2020. I wanted to ask you about this too, which is that in 2020 we had a disruption due to the pandemic, but we didn't have Iran firing weapons at its neighbors, right? And that's different, right? So what is the difference between those two circumstances?
There's a lot of differences here in the sense that what happened in the pandemic was a massive demand swing. People's lives completely changed. They decided they didn't want to live in the city. They wanted to own a car, and they wanted to buy a bunch of home goods out in the country. And so they put in orders for all of those things. I remember your freezer or your dishwasher. That was the one. My freezer. So the dishwasher issue. So everybody put in 3 or 4 orders. All the ships around the world that were sending this merchandise from China were locked behind each other. They couldn't get to port for every kind of good everywhere in the world. And that's bigger in many respects. But this is a really terrible concentrated shock for petroleum, gas, and then a few things like helium fertilizers that go through. Now, you could see that Saudi Arabia is in a different position where they have that westbound pipeline, which is allowing it to get into the Red Sea, which is not without its own risks of attacks, and then the Red Sea has its own issues. But I just bear in mind, we were thinking back in 2022, for example, that pipelines were cut from Russia to Europe, and they were doomed. There was just no way the commodity was going to get from here to there. You give it a bit of time, and then we can adapt. So I think one of the things that we're going to study today is that how bad this shock is, how long it lasts, whether there's any real infrastructure damage. We've already seen some in Qatar, but Are you going to see much more of that? That really changes the whole character of this. For now, energy markets are pricing this in to be a severe short-term supply disruption. That picture on the right, you're going to see that ports in the UAE come back online.
Great. Let's go to the next slide. And by the way, my dishwasher was in fact delivered yesterday from that COVID period.
Yesterday.
So let's take a
That's
look.
fast.
So yeah. So right now, what's interesting is, and I don't think this is a big point, but it's kind of obvious, is that one of the big differences, right, from 30 years ago, right, in the 1974 supply shock, is simply that we've just hugely boosted the U.S. production of oil, right? So it doesn't affect us as much.
Yeah, and you take a look though, in terms of fungible commodities, West Texas Intermediate, Brent Blend, all of these things, they're going to move very close to each other because there is an ability to substitute. There's a big cost difference. Maybe it's like a 6% cost to try to get some American crude and to move things around. But we will suffer very similar price increases, but there isn't going to be an issue of shortages. When you're seeing in some places an absence of jet fuel where you can't fly, that's it. You're being limited by energy. That's what's going to get you a larger economic impact. That is similar to 1974, though again, it's different in many characters. The rest of the backdrop around the world is a little bit more able to adjust.
Great. Let's move to the next slide. So, one of the things that I love about your work is that, we talk about what is the impact of energy prices, and you've actually calculated it. Now, you're going to talk about things in 170 billion, which I like for this year. I'd love to turn that into, something that people can tangibly attract. But what's interesting about that number, Stephen, is it turns out that is exactly what the real cost of the tariffs was last year, right? We expected them to be 500 billion, right? No, but it's true. We expected them to be 500 billion. It turned out they were much less, but that number is very similar. So what does it mean when we talk about $170 billion in incremental cost?
Yeah, I think it's really important to say this, yet again, sorry about the construction costs. At least something's going on in the economy. So the thing that we want to think about here is this is what the market is pricing. You may have a different view. You may tell us, you guys are crazy, the price of oil is going to plunge or it's going to soar. And the market has a set of prices. So roughly a year from now, it's expecting Brent that was 70 or a little below 70 to be around 80. So it's still going to be a lingering issue. There's going to be some damage here. And just hedging, having these different market participants who have different views. Some say this will last forever. Some will say it'll be over next week. When they come together, you can see some of these things, like the picture on the right, which just shows what the path of, there's some seasonality to it, what gasoline futures would have meant for the retail price of gasoline. By the way, diesel has risen twice as much as gasoline. When I say $170 billion, that's economy-wide costs. Now you see on the left picture, that black line, it shows total energy costs. The ups and downs are being driven by these incredibly large moves in energy commodities. Beneath the surface, electricity has been going up with AI demand. And that's been going up at about a 7% clip, but a lot more steady. So when you think about this, we're talking about $1.25 trillion for the U.S. economy in total spending, up $170 billion if you take these futures prices and you embed them. And even though you can see that light blue line on the right, they say the gasoline price is going to be, highest within about a month or so. Even if it comes down, next year the growth rate would be negative, right? It would be a price relief. But yet what it's showing is that the level is higher. So there's a $60 billion incremental cost in 2027. That means the economy in some ways has a bigger burden on it, and it means more energy profits and less for others on that.
Right.
And
we're going to talk a little bit about that, right? And to make everyone, on the same page, right? So for every dollar, right, that the energy companies make, right, $2 is lost by the consumer, and we'll talk a little bit about that later. Next slide, if we can.
That's a rough estimate.
Rough estimate, right? So here's the implied cost, and I think this is a great illustration, right? So if you think about it, right, these are the total energy costs borne by the consumer, right? Last year, retail gasoline, $380 billion total cost. This year, 407. Next year, 20. By the way, that should say 2027. 467, right? A net change of 87. What's interesting is the acceleration, right, in gasoline now far exceeds that of electricity. And really, what I was going to ask you on this page, Stephen, is the cumulative impact, right, to consumers, right, is inflationary because now all of the energy they consume is going up in price.
It's yes. I mean, what you're saying is that consumers have to dip into their savings to buy the same quantity of goods or cut their demand for other goods. And the price of these commodities tends to be really flexible, and a lot of other prices, if we slower demand, the price doesn't go down. So we'll just experience less growth and higher prices. And is it inflationary? Is the Fed going to say, well, you know what? Let's send you money to pay for all of this, like we did in the pandemic? They won't. And then next year they're going to say, you know what? We want to make sure that this doesn't feel any worse, so let's send you some more. And you keep going on that way. That's the 1970s. This is not too much money chasing too few goods. It's fewer goods to buy. And that's why, again, we think about this inflation so
and that's the whole idea. That's right. A reduction of aggregate demand.
Just to be clear on the table, so what we did is we put the prices that would have been there right on February 27, and then the prices roughly now, which change a little bit every day. But what you can see is that we would have had a much lower increase in total energy costs. It would have been below the inflation rate, kind of helping us out, if not for this strike. And that's the case, even though the market is assuming we're going to have this blow off very quickly and then start to go back to normal.
Great. Next slide.
Let's make the point on the next. I just wanted to make this point. If you look at, these are just taking these prices, running it through our estimates. And what you can see here is that there's a CPI increase. That's full year average. Like the month of March is probably going to have a CPI gain above 1 full percent. That's 12% annualized inflation, right? And that's just happened. Let's think about the full year average CPI is up 0.6%. Real GDP is down more. So we're assuming there are some negative costs here. Debt capital costs, you mentioned, David, 40 basis points higher, wealth a bit lower. That's private and public government debt. It's been about the same, surprisingly. And it's been US and non-US has been about the same. And you have to think that sort of energy producers, like energy producer countries, you can understand, they save money and consumers don't. So if you make, what you end up with is some increase in savings, right, in a sense, by shifting the income to them. And
but it's going to the corporations, Stephen. And the point that I wanted to just draw out of this is when you reduce real GDP in the U.S. by 0.75%, that is very significant, right, off of a 2.5% base. Similarly, right, you're reducing global GDP by 1/3 this year, right? So these are large impacts, right? And by the way, to make everyone understand, Stephen's estimates assume a normalization of that futures curve. These impacts that he's estimated are assuming that it is a short-term shock and not a longer-term one. So it's important to take a look at that. Next slide, if we can.
Yeah. The market assumption.
So one of the questions that I discussed with Stephen at length yesterday was which are the beneficiaries, if any, in the stock market, and where are the areas where there is a real negative impact? And just like we presented the data to you earlier, that there are beneficiaries, in this case, the energy complex, right? The fact is that for every dollar that the energy complex improves, certain sectors actually are hit even harder, Stephen. So let's talk about what those top 4 sectors are that are not going to do well.
Yeah, the not do wells are the consumer sectors, including staples. If you think about, their cost of business, the cost of Tide detergent or something like that is going to be higher in terms of their commodity costs. So consumer discretionary staples, industrials, there are pieces of this that have a really strong story going on, including defense contractors, for example. But if you put in the different transportation companies, just think about their energy costs. That's an obvious one. Materials, commodities tend to move together, but a lot of the energy costs for especially American advanced materials makers, those are all problematic, all of those circles. Now, I'll tell you, some of them have just moved in line with their earnings estimates. We think the consumer could fall a little bit more. But take a look at the blue one. That's energy. Now, if you look at the earnings estimates, this quarter just passed before the shock, energy EPS was about flat. The analysts are estimating this is going to be a year of about 11% EPS growth. But what have the shares done? The shares are up 34%. Now that tells you the equity market for energy companies is predicting a tripling in estimates. And I'll tell you that could be too low. If the oil shock worsens, it'll probably do better before it does worse. The energy sector is has the most cyclical profits, the biggest ups and down swings. You know, they say the cure for high oil prices is high oil prices. Well, if you get an economic contraction, you're going to have a problem even if the Straits of Hormuz are closed. So
Exactly.
I would just tell you that this is an area where you probably have some more upside if the oil price moves up. But at an extreme level, you got to remember it doesn't last. But here you go. Those are the sectors that have some ups and downs. The market has done its best to be fairly efficient. And I would tell you that the way the futures prices look, and again, we didn't make this up, that's what traders around the world have come together and done, is telling us that maybe the hit to overall corporate profits would be about a 4% hit from this. That doesn't mean estimates will come down stock prices.
Great. Let's move ahead. So when we think about all of this, right, what is critical to us is making, and we'll talk about this at the very end of our broadcast, is what do we do in our portfolios, right? And you'll be shocked by the answer in a second. But what's really interesting is that we've seen a reversal in the trend that we really like, which is the decline of the dollar, right? And we'll talk about that in a second. But if cash energy prices follow futures, which is to say, if the actual future energy prices fall, non-US equities will rally and the US dollar will fall. That combination is very powerful for our portfolios today because we have 31% of our portfolios in international equities, right? And obviously, we do expect
it's about 21% of the portfolio of the overall portfolio.
Exactly. Sorry, 21, exactly. And so let's leave that fact right on the table, and we'll talk about that in our portfolios. But on the right-hand side, I have to be really honest with you, Stephen. You know, you take a look at the inability for any real non-correlated asset here. As I mentioned at the outset, everything has gone down. But I want to talk a little bit about Treasury returns and gold, right? This is kind of an odd moment, and we've seen our tips do very well. But what does this tell us?
Well, the two circles there, like to show you how different the environment is. It's an environment of falling yields, falling dollar. Gold loves it. Well, then you get an environment where oil means everything. It doesn't mean everything, of course, but it's the big dynamic mover of the moment. It's so big relative to other little trends that suddenly everything is being sold off except for oil, the one thing that constrains supply. And so now the correlation is gold goes down, bonds go down together, all of those things. And the same goes for just about everything else, with the exception of, derivatives that meant to go down in price when assets. But the thing is, when you see the peak in the oil price, we mentioned in the case of Ukraine, it was a month after the conflict started. Then you reverse this. The correlation stays very strong, right? You said so non-US equities would go up, crude oil would go down. You get some of that out of the way, and then the correlations break again. And you go back to things like, oh, what's going on in AI? That's important, right? So that's exactly the way that
really important. Exactly. So that's the point of where we are at the moment. Let's move to the next slide. So with all of that, right, one of the things we wanted to talk about is let's take a look at what happened in actual portfolios, right? So first of all, I wanted to go back to the slide 2 ago, which is we're still expecting, right, positive growth rates in spite of all of this, in spite of the impact of AI, in spite of all of these things, right? We're still talking about positive growth rates. We wanted to point out that non-US shares at this moment, even after a reversal, are still doing 3.5% better right now than US shares are. But they were, at one point, 9%, right, ahead. And so one of the things that's important, right, is what do we decide to do today? And Stephen and I, as you imagine, could spend a lot of time, considerable time talking about this. And we are holding our portfolio allocations, right, assuming, of course, that we expect the oil shock will abate. And then we're going to talk about a trend resumption, Stephen. So How strongly do we feel about that, and why?
So we're naturally uncertain about how long the shock lasts, how big it is, these sorts of things, because you can get military experts and they'll tell you things. And we've been through this many times in the past. And what you hear and what actually happens is often very different. And so I think towards the end of this deck, we want to go into what do shocks look like for markets and the economy. They truthfully are shorter in duration and usually not a turning point for the whole world compared to when you have booms. You know, if you think about like subprime mortgage housing, you know, and like building up 5 years of incredible weakness in the banking system, well, that lasts and takes you down for a couple of years. These things tend to reverse. And so ultimately, we think that we're going to have a period where we'll be having the Federal Reserve saying, we're going to hold off now. We can't accommodate this. We can't send you money. Otherwise, we have inflation all the time. But they'll focus on the labor market later. And the dollar will come down again at that point. And if you've taken this drop from 9%, you know, down to 3.5%, you want to maybe, you know, say, well, okay, that's, you know, the issue of the moment. There's no guarantees here, though. And our portfolios are not overweight equities. They've got this mixture of different assets. The problem is the only one that's going up today is oil.
Exactly. Let's go to the next slide. So, you know, I think actually we've made this point pretty well, right? Which is the beneficiaries of this obviously are the producers of oil. They're also not consumers, right? They're the, you know, the countries that actually produce the oil. And ultimately, right, we don't think that oil production itself is a long-term growth driver because the world, as we mentioned at the outset, is in fact awash in oil. And so, you know, it's not an area where we want to spend a lot of our time in terms of exposing our portfolios to energy shares. But the fact is that, you know, we think over the long term that certain commodities, especially essential, you know, metals and rare earths and other things like that, are going to see fundamentally strong demand, especially things like copper and other materials that are necessary for the AI boom to continue. So these are the areas where we look and make adjustments in portfolios. But Stephen, as we talked about, they're not an area that are of particular interest to us over the long term.
Well, let's stay on this. You know, we have a full neutral allocation to American energy companies, the oil producers. And if you take a look at this picture, the one on the right, suddenly they performed really well and they helped while other things fell in portfolios. Now, if you take a look at the futures prices on the left, and you can say that all of the expert energy traders of the world are crazy. It's only going to go higher. Well, then that picture on the right will go higher too. But if it follows this path, you're going to have a hard time performing after that 33% rise. And the truth is that energy producer stocks on a risk-adjusted basis have had a return about 30% below the S&P, you know, since 1990. And they've been very volatile. So they serve a purpose. And again, what we did, we think that the natural gas business, I think that's the next chart. If we turn the page.
Yeah. Move ahead, yeah.
If you look at this rise in natural gas and look at like the need for energy transmission. So we have the neutral position on, you know, crude oil producers, but we have this overweight on energy infrastructure and transportation, including natural gas export terminals. Right, so there is energy in our portfolio. We're going to, like you said, we're going to like some commodities, even if it's not like the best long-term equity. But we want to be careful in thinking that, well, the only thing that you can buy now is oil. Well, take a look at what can happen. History shows that we have really extreme movements in oil, both upside and downside, including quite a few energy busts. You know, over again, 2013, 2020, the energy companies were in trouble because the oil price fell so much they had trouble servicing their debt.
Right. It's funny because this week I've had a couple of conversations with hedge funds who said to me, we're selling our oil and buying our software. That was their sort of comment this week. Two people separately. Very interesting. Next slide. So what is a safe asset? It's very interesting. And we have, you know, 22%, right, of our U.S. treasuries, right, are in short-term inflation-linked notes. These notes obviously benefit, right, from, you know, changes of the price of the underlying security and from the rate of inflation. So it's been very interesting to watch their behavior, Stephen. This is another area, actually, of very few that have done well.
Yes. So why short duration? Well, because the whole bond market is getting sold down across the world, and the high long duration bonds have greater price sensitivity. So they're going to get marked down by 1% at the long end of the curve and only 0.2 at the short end of the curve. But in the case of inflation linked bonds, both of them get a CPI coupon. Well, so they get a coupon that's adjusted for that. Like I said, in the month of March, they get an extra full percent. So what happens here is the bond market, these markets, they talk about efficiency, we can talk about that, and all those crazy ideas that markets are perfectly efficient, but they try to be efficient. And so these nominal treasury notes try to have a yield high enough to give you some inflation compensation. And these have a 1% coupon plus the actual inflation rate. But why is the blue line different from the black line? So the actual performance of TIPS, short-term TIPS, has been better than the US Treasury market. Well, a little bit of that was because the yield curve was very flat in the last few years and the Fed was tight. But another part of it is that we had unexpected inflation. And if you look at the pandemic, TIPS were getting paid, right, for those supply shocks. Now they're doing the same thing. They're getting that inflation compensation because things aren't going well in the Persian Gulf. And so that's exactly the thing. So if you want to have a safe asset, right, this is really a very good safe asset. So what about your cash? Exactly. Your cash isn't going up and down, but it is losing value to inflation, right? So this is one of those things that's very cash-like, plus it gives you inflation compensation. And we can't recommend it as like an incredibly cheap asset or you should have your whole portfolio there because it's not going to rally a lot. But this is really the safe asset that we would talk about. Now, in terms of a hedge, it is possible that if you're a trader and you're nimble and you're going to say, I know better than the whole market, you can take a small amount and you can hedge by owning oil. Let's just remember what happened in 2020 when if you can't take physical delivery for oil unless you got a very big truck.
I'm going to write that as your quote of the week, by the way. I think that's very funny. Let's go to the next slide. That's totally true. So, the Fed right now, is, as Stephen has sort of implied, is likely not to take any action. It is likely to basically stay where it is today, hold, because of the fact that inflation is actually higher. Markets therefore have priced out, right, the chance for rate cuts. We think that will be reconsidered, right, as the year goes on, especially when oil declines in price. Now, the question I have for you, Stephen, on this slide is, well, what if unemployment rises, right? What if AI has more of a bite out of employment that we expect and oil declines? Does that change your sense of what the Fed might consider?
I think it would bring in the possibility of larger rate cuts. And the Fed is, subjective. They'll tell you, we'll see it, we can't even tell you. But the reality is if you get these spiraling negative effects, and at that point, if inflation fever breaks, the Fed could take us down more than markets discount. And, I think zero is a long shot, but a 2% funds rate in that environment is possible. And I would say that that's more likely if things go badly and the outlook for 2027 is looking quite bad. The Federal Reserve could be back in the easing game. And let's just remember, if that sounds extreme, the bond market went from pricing a couple of cuts, which is the Fed's base case view, to pricing in a slight chance of a rate hike. And we already have these issues. Chair Powell is staying on as chairman of the Fed because the Trump administration is not dropping its investigations of Powell, and one senator is holding up the seating of the nominee for Fed chair, Kevin Warsh. So there's all sorts of things that are going on that can kind of hold up rates now, but eventually you may pay for that and you'll get lower rates later. That we think will drop the dollar.
So thank you. Great. So we're about to come to the end of our broadcast here, and we want to just cover a couple of more points. So let's go to the next slide. So as Stephen pointed out at the outset, right, this is very important, which is that when we take back a look at all of the geopolitical shocks, just like the one we're in right now and the war in Iran and the impact that it's having on oil and oil prices and energy in general, only twice have these types of events actually had a long-term impact on the direction of the world economy: in World War II and in 1974 during the OPEC oil crisis. the chart below, which you can look at your own leisure if you actually click onto our deck, shows you, right, the fact that 30 days and 90 days after all of the other, right, 19 events, we saw markets at least resume, right, in a positive direction. And Stephen, I think that really is the message, right, which is we have to be very careful not to have a portfolio that's reactive, right, because these are shocks, right, and often those are unwound.
I think that in showing, is the market worried about higher oil? Energy shares up 34%, the rest of the market down 5%. Yes. Is it worried enough? That's a question we can all ask ourselves. But this data should still be in the back of our minds that we tend to get very emotional in moments like this. And we just don't, we had asset allocation. We owned some things that are not going down in price, like Treasury inflation protected securities. Those things were dragging our portfolio down when equities were going up 20%. We could have been in equities. So that's why you already have a portfolio that can live with all these different outcomes. Let's just turn to the last page, exactly. I think is the last one.
Yep.
And just make this point about booms and busts. And, we put out a piece in January, again, there was a title on this. I don't know if we changed it. It was sort of like busts versus shocks, a primer. Now, this will just try to give you an example. This is more recent history, but we used a log scale on the S&P return. Now, take a look at what, the year 2000 bust looked like. That period where equities were going up 25% per year. We had massive wasted capital investment. You take a look at that shock and how bad it is. And unwinding that was very difficult. We ended up with, the equivalent, if you look point to point, a lost decade in the equity market. Then the subprime build out and like how the banking system didn't have enough capital and there was huge problems generated the global financial crisis. Well, then you have the 08-09 downturn, really severe again, and point to point, it took years to get your money back. Now look at the pandemic in 2020. That was a more severe economic shock that dislocated the economy, but it wasn't permanent. It wasn't that we had, misaligned the economy in some sort of way. And that's about the worst one I can think of. Now, maybe we papered over it a lot and paid for it with inflation. That's probably fair to say. But you go back to other historic shocks. You go to the Persian Gulf War in '74. You find that these booms, those are the ones that we really have to worry about. And I'll tell you, we are worried about booms in a completely different way than markets are worried about today with the focus on oil. And that's all about whether we misalign the economy related to AI investment. And the jury's out. There's different elements of that picture. We'll save that for another day.
I'm looking forward to getting back to that conversation. So thank you very much, Stephen. I know that this has been a long conversation today, but I want to conclude with a couple of points, right? Number one, we're not changing our asset allocation in our portfolios. We genuinely believe that we're going to see a resumption of some of the key trends in terms of the performance of non-U.S. shares, the dollar as well reversing itself and going into a decline, and obviously, a return to the more fundamental growth drivers that had us begin this year. As Stephen mentioned, I think we're going to be returning also to a time when we have to talk more about AI and its impacts on the markets and imbalances that may be taking place there as well. But for the moment, right, please do not be reactive, right? Stick by your convictions in your portfolios. Make sure to maintain that quality orientation and remember that being a trader is harder than it looks. And with that, we want to thank you. We'll see you next week on The Point. And we hope that you'll read our commentary this weekend, which provides even more insights than those that we've provided today. Thank you, Stephen.
Thank you, David.